Hello and welcome to week 51, the final weekly review this side of the year. Next time we'll be meeting each other in 2022 January. Kicking off this week's review by having a look at real yields. Real yields started a good bounce in middle of November as markets are anticipating more rate movement from the Fed, which has been approved, sort of, if you may, by the Fed last week, and real yields started shooting up. Surprisingly, gold didn't move down with it. For those of you who don't know, gold and real yields have inverse correlations. So if I were to invert this chart and compare it with gold, you can see that peaks and bottoms more or less are in line, and the correlation runs thick usually. But surprisingly, gold didn't dip as real yields lifted up. So that's something I keep an eye on into the year, and I really expect gold to come down at least to 1750 again before it does anything. Now there's this yearly seasonality, I should say, in gold. If you can see, this vertical orange line are Januaries marked every year, and there's a seasonality with gold that every January tends to rally, surprisingly, and I'm not really sure why, to be honest. At some point I just gave up and started buying gold every January, made money, which is great. So I'm expecting sort of a repeat of that. Last year, so I should say this year, it wasn't as strong, but usually the seasonality holds true, and I really expect as we move in next year, January, I see another gold rally for no other reason than it is what it does every year. But in the short term, expect gold to maybe give us a dip. In January, I would expect to rally, but overall, I'm really expecting gold to come down as real yields will probably keep bouncing higher from here on. So that's something to keep an eye on. And as we're also moving into the next year, you'll see that there's a lot of analysis coming out for what will happen in the rest of the year, and there's a bit uncertainty about some things. For instance, where there's loads of analysts saying that Euro-USD should come down from here. A lot of analysts saying dollar will be way stronger, which should prove to be true. So I won't go too much into details about what dollar will do on its own against other assets, because I think that is well communicated by everyone else. But I'm going to show you something else, something you will be able to use next year a lot, and that is the US yield curve. So the US yield curve is made up of, it's this chart here. The US yield curve is made up of the 10-year yield minus the 2-year yield, and will give us a percentage. Right now, my analysis shows that we should hold the 0.75 level fairly strongly. So you might dip into that again, but I really expect a bounce back up into the 90s level. As you can see, the yield curve contracted or went zero late in 2019, and usually that foreshadows recessions, as it did in the GFC and as it did with the last recession, even though it was more pandemic driven. So you can overall take from that the yield curve will show us the health of the expansion, the global expansion, I should say. So as that is topping off, and as I believe the real yields, the yield curve is showing us that we have topped off, that also means for pairs like AUDJPY, so if I were to correlate with that, we'll have found a ceiling, maybe even for the rest of many years to come. And comparing these charts makes it incredibly easier to understand why the yield curve is so important, and why AUDJPY, even all the other pairs that are the cross currencies with the yen as USDJPY and other pairs, are so closely correlated, because it shows us that that expansion and where we headed in the cycle. You're looking at the yield curve, it looks like the expansion is not going to be as long as it might, and we are actually heading lower into the 0.45 level next year. Again, this side of a year and for the few months to come, I really would like to see the 75 level hold. We see maybe another bounce, but for the time being, it looks like yen investors aren't as optimistic next year, and it could mean a bit more yen that stalls the usual yen outflows out of Japan, and should see lower levels for a lot of the other currencies. So let me change this into a candlestick chart and take the comparison away as well. So you got a fair understanding what the yield curve does and why it's so important for yen pairs. And this is one of the things we can analyze a bit easier, because there's probably not a lot that will change this. going into next year. So looking at AUDJPY, as the yield curve kind of topped off in May, April this year, so did AUDJPY. We saw a rally after the symposium meeting in late August, but that kind of fizzled out, and now we saw this bounce here where the yield curve bounced from the 0.75 level as well, and it's starting to come down again. I'm expecting this to still come down a little bit lower, but really the magic happens between those levels on the yield curve. So if you keep an eye on that, you have a fair grasp of how to trade these, and the yield curve is telling us that all yen pairs have probably found a ceiling for considerable time. So if I look at other pairs as well, GBPUSD, these ceilings, they really should hold as long as the yield curve continues to flatten out and come lower. Same thing with probably CAD-JPY, CHF-JPY, EUR-JPY anyway. So all seeing a top in there, and USDJPY should really hold at 115 level for a long period, as I'm not expecting really a lot of movements to happen out of that realm. So that's really to understand what the yield curve is and how important it will be for yen pairs going forward. So you might see interim rallies. So even if you plot your technicals and you think, okay, we might have a significant rally in some of these pairs, reality is as the cycle is slowing down, really that outflows from yen is going to be less and less, and people will be putting their money more into bonds, and this whole thing will just start coming back down again. And trade a bit more boring. The same thing happened before the last recession happened. So if I were to scroll back, we saw the expansion sort of peak out in 2017, I think, or even before that. So if I have to look at a yield curve, we can see that again. So here we can see that the expansion on looking at AUDJPY's chart kind of stopped in about 2013. I'm fairly confident if I were to look at the yield curve, some similar is evident. So the yield curve would be here, and we saw a top in about 2013 as well. I think a few months after actually AUDJPY topped out. But you catch the drift. The yield curve really tells a story here. It tells a story of where yen is trading. It is incredibly powerful thing to have, and right now the yield curve is telling us, look, we found a top again very early, which made this looks like this cycle is going to be really shorter cycle, and we're going to be bouncing about these levels. Eventually we'll drop down to 145 again, which makes trading yen pairs incredibly easy going forward, because you kind of know you want to short these. Any rallies we need to be sold as the whole global cycle is slowing down. I've put a bit more effort into explaining these things and less probably about what's happening in the rest of the calendar, all these other pairs, because I want to emphasize on the things that we have a better grasp of, or the things that make a little bit more sense going forward. That makes trading way easier and analyzing way easier as we move into next year as well. There's loads to discuss about GBPUSD, EUR/USD. They made some significant moves last week as we were expecting. So Bank of England did a surprise rate announcement. We saw some crazy movements. Really the movements was all about hedging. I said that in last video as well. Don't pay too much attention where things headed. So we had the Fed announcement here, then we had the BOE announcement, and 80% of the time these Fed announcements get filled. So we saw the backfill here, and once this backfill is completed, we can start making a decision. Okay, do we want to continue shorting GBPUSD, or is it time for a rally? That's something that I will be looking more into as the days develop and the weeks roll on. Don't want to make huge level calls just now, as I think there's still a few things to be resolved. Same thing for EUR/USD. Expectation is EUR/USD will be trading way below these levels, another 300-400 pips lower from here. But timing is always key. So if you held that view that EUR/USD will be trading lower 400 pips in here, you had a really bad timing, because you'd be sitting on that trade for over a month and nothing happened. So really what we like to do, we want to time these trades a bit better. Overall bias for EUR/USD is to go down. There is the yields telling you that's what's going to happen. US growth is quicker. Fed will be hiking rates way before ECB does anything. So there is a monetary divergence as well, that's helping EUR/USD to come down as we are moving into the next year. If I were even to go on to the monthly candles, that emphasizes there a little bit more. There's nothing on the economic side to say that EUR/USD will be reclaiming the 120 or even 116 again. Nothing, absolutely nothing. It's going to continue to come down until it sees 110 taking out back into these levels, and then after that we can reassess where we are with things. So that's the two trades you want to keep in your mind as we're moving into next year. that Euro USD is very likely coming down, and most yen pairs probably found their ceilings as well. And that's the direction you want to take it. That's all I wanted to cover next week. The data is not going to be a lot of market moving, so I will be keeping an eye out on Thursday's US core PCE data. That will be probably the last trading day this side of the year which anyone will be taking seriously, and for that expect USDJPY to move quite strongly. My bias is probably lower because the way the yield curve is showing us. So that's something you want to keep an eye on as we move on to Thursday. But altogether, everybody's more thinking about wrapping up business next week. It will be a shortened week as well, as Friday is a holiday, and then that following week nothing's going to happen anyway. It's just the spreads will be so wide, it's going to be so unattractive to trade, and that's how I'll be approaching it as well. I'll probably put my feet up, enjoy the holidays. We had a really good year. And what I will do is, moving into January, we'll have a couple of videos explaining all the moves that happened last year, all the things we did right, all the things we did wrong, or teachable moments I like to call them, and we will take it from there. If you are subscribed to my trading room, you'll know that in the end of last week of December, we'll be activating our FTMO challenge, and then moving into the next year, we'll be trading a bit more actively. But that's something that I won't advertise here anymore. I think I've beaten that horse already. It is well communicated what we were doing on that side. Apart from that, I wish you really good holidays, a happy new year when it comes, and well done again for this year, everybody who pulled through. It was incredibly difficult and challenging because it was probably for most of you the first time you traded a post-recession scenario, and it turns out to be extremely short expansion by the looks of it so far. So a lot of things happen very quickly, which in the past maybe will take 6 months or a year to play out. Now we saw things play out in a matter of months and weeks, and loads of pivots from central banks as well. So if you are positive this year, give yourself a pat on the back. It was incredibly difficult to trade. And that's all I wanted to cover in this video. Again, happy holidays, and I'll catch you all on the flip side. Thank you and bye.